Today is the 29th of September 2021. My name is David Hickson, and in today's market update I'm going to be speaking about the S&P 500 again. I have recently been trying to bring in additional instruments to these market updates. Recently I've covered gold and Bitcoin, but there are times when market action just requires some extra discussion, and there have been some really interesting things happening in the S&P 500 and indeed in stock markets around the world, and I think they bear discussing because the devil is in the details, as they say, and there are some very interesting details to discuss. First of all, I must apologize for the fact that this video is being published on Wednesday. I have got into the rhythm recently of producing these market update videos on Monday, and I received many emails and other messages asking where the market update was, and I apologize for the delay this week. There is a good reason for the delay, which is that I have been putting the finishing touches on a new course that we have made available. In fact, we launched the course yesterday, and I was so busy putting all the final details in place that I just didn't have time to record a market update video. This is the new course, and I'm very excited about it. It represents a slightly new direction that we're taking in Sentient Trader, where we are putting more emphasis on training and education. This is a fascinating and very powerful approach to trading financial markets, and we are putting a lot of energy into teaching others how to do it. And this is a short mini course that I'm very excited about. It is a foundational course, as you can see. It's Trading with Hurst Cycles, the foundation. It covers the basics of all the things that I speak about in these market update videos, and it provides a really good introduction, in my opinion. It's a mini course. It's about 2.25 hours worth of learning material, and you can see all of the lessons here. And indeed, in some of the lessons I was foolish enough to put myself in front of the camera and actually speak to camera, as you can see. Not something that I do very often. So we're very excited about this course, and we launched it yesterday, and there is a launch discount on it. So if you are interested in learning about this approach to trading financial markets, take advantage of the launch discount. I'll put a link in the description below this video. I think it provides a really great foundation for learning this approach to trading financial markets. I should point out that even though the content is all in English, of course, we have full audio transcripts available. So if English is not your language, then you can download the full audio transcripts and you can use those to help you through the material. Speaking of which, let's take a look at those markets. And we're going to start here with the preferred analysis, my preferred analysis. This is the analysis that we have been tracking over many months, and I'm sure that by now you are familiar with this analysis. If you aren't, I would encourage you to take a look at previous market updates in this series. The important thing, of course, is the 54-month cycle trough that formed in March of 2020. The difference between this analysis and other analyses that I have been looking at in recent market update videos is this 18-month cycle trough, which you can see I have influenced the software to position in the middle of July. That's what this pin symbol means over here. That means that I have influenced the analysis, and so I have positioned that 18-month cycle trough over here in the middle of July. And if you take a look at the previous market update, you will see that meant that we were expecting an 80-day cycle trough to form last week. And we'll zoom in a moment, and we can see that the software has indeed confirmed. Well, it's confirmed to some extent. There's a little subtle detail to be discussed there as well, that the 80-day cycle trough formed last week. Let's quickly take a look at the other analysis that we have been discussing in recent market update videos. This is what I call the default analysis, because it is the analysis the software is performing without me influencing that software at all. However, I should point out a very important subtlety here, which is that there is no global default analysis that Sentient Trader as a software application performs on an instrument. Sometimes we get requests from customers asking for what the current analysis is that Sentient Trader is providing. Sentient Trader is a tool in the hands of the analyst and the trader, And as such, there is no global default analysis that Sentient Trader performs. What I call a default analysis is what happens when I load data into the software and the software performs the analysis without me influencing it in any way. If you load different data into the software or a different amount of data into the software, you will result in a different analysis possibly. You might get exactly the same analysis, of course. And the other subtlety, which I won't go into in too much detail here, is that an analysis progresses over time. So just as a human analyst, when they are approaching a market, will look at the analysis they made yesterday and consider what recent market action has done to affect that analysis, Sentient Trader does the same thing. And so Sentient Trader has an awareness, if you like, if software can be said to have an awareness, it has an awareness of the progression of the analysis. Which is why if I was to load the same data into the software and start a brand new analysis now, there might be some subtle differences in the analysis. They would be very subtle, I should point out. It wouldn't be a totally different analysis, but that's another consideration. So the implications of this analysis were the important differences really between this and my preferred analysis are simply the fact that the trough in the middle of July has been phased as a trough of 20-week magnitude as opposed to 18-month magnitude. You can see from this whisker, which is this line here, indicating the range of reasonable time in which an 18-month cycle trough could have occurred, you can see that whisker is actually reaching over that time period. And so even in this analysis, Sentient Trader is considering it possible that the 18-month cycle trough could have occurred. But what is more important than simply when we expect a trough to occur when performing an analysis is the complex puzzle that needs to be solved in the analysis process, which is the positioning of all the shorter cycle troughs. And that's more important really than the exact time at which we are expecting a trough to form when trying to produce a good analysis. Now, there is a small detail that I should point out about this analysis, which was raised by one of our community, a very experienced analyst, who pointed out that the wavelength of the 40-week cycle here in this analysis is at 345 days, 46 days perhaps, and that makes a very long 40-week cycle. It's something I haven't actually highlighted in previous videos, but it is an important point. The average length of the 40-week cycle is 272 days. And if you don't understand why the average length of a 40-week cycle is actually 39 weeks as opposed to 40 weeks, I would encourage you to download the 10 Core Concepts document that I will provide a link to in the description below this video. And so the average length of a 40-week cycle is 272 days. One of Hurst's fundamental principles is the principle of variation, which tells us that cycle wavelengths vary and cycle amplitudes as well. And in fact, all the details of the cycles vary from one iteration or one wave of the cycle to the next. And so this cycle trough has been positioned at a 27% variation. Now, different analysts have different ideas about how much variation is acceptable, and I should acknowledge that some Hurst cycles analysts consider 27% too much of a variation, and they would therefore consider this analysis null and void. I feel I should point it out. For me personally, as an analyst, I think a 27% variation is just about acceptable. And so I do still consider this analysis. Now, as I pointed out, the difference between this analysis and my preferred analysis is the magnitude of this trough in July. If we zoom in on this analysis, you will see that, in fact, if I get the zoom scale right, there we go, you can see that the trough that was expected last week, and which has now been confirmed by the software, was a trough of 80-day magnitude. Now, I mentioned earlier that it has been confirmed to some extent. What did I mean by that? Well, you will notice that the diamonds at the foot of this chart are hollow diamonds. Hurst actually recommended that if we were not absolutely certain that a particular trough had formed in a position, then we could mark that position with a hollow diamond and fill in the diamonds when we were more certain. when we were even less certain, we could position a question mark, which is something Sentient Trader does, but it tends to make the analysis a little bit messy sometimes, so I hide those question marks. Nevertheless, you can see that the software has now confirmed that the 80-day cycle trough has formed at this point in the market, and so the comparison between these two analyses, as I mentioned in last week's market update, at this level is really quite subtle, because they were both expecting an 80-day cycle trough, and we will see in a moment that both analyses have now found that 80-day cycle trough in the price action. So what is the difference between these two analyses? And the reason why I keep showing you both of these analyses is because there is an important difference, and it has to do not with what we're expecting, or what we expected last week, I should say, but what we're expecting over the next period of 80 days, the next 80-day cycle. So let me show the composite model line, which is the composite of all of the information that has been derived from the cycle analysis of the foot of the chart. This is the composite model line for what I call the default analysis, the analysis that I have not influenced. And let's just zoom in and take a look at this period of time here to compare what the difference is between our expectations as a result of these two analyses. As you can see, the composite model line is showing that we are expecting price to bounce out of the 80-day cycle trough, which probably formed hollow diamonds there on Monday of last week. And so we are expecting price, of course, to bounce out of that 80-day cycle trough. The important points about this composite model line are two things. First of all, the 80-day cycle will form a peak over here. And what's important about that peak is that it is an early peak. Can you see that in the full shape of the 80-day cycle, there's the nest of lows for our 18-month cycle trough. In the full shape of this 80-day cycle, from this 80-day cycle trough to that 80-day cycle trough, that is an early peak. So that's one thing that this analysis warns us to expect, is an early peak in the 80-day cycle. The next thing, of course, is that it is expecting a stronger move down following that early peak into this trough, because it is expected to be a trough of the 18-month cycle. Now let's switch to our other analysis and compare the expectation, which is provided to us by means of the composite model line. The composite model line is a very useful way of understanding the implications of an analysis. And let's zoom in. Well, you can see, first of all, the sort of bigger picture. This composite model line is telling us to expect the market to keep moving upwards. So where is the downward price movement? There must be some downward price movement. And that represents, it's a good example of one of the limitations of the composite model line, is because it is using information from the cycle analysis. Recently, the shorter cycles amplitudes have been squashed. They've been squeezed down by these longer cycles. The market, it doesn't take an expert to recognize, has been in a bullish trend since March of last year, the end of March last year. And the reason for that from a cycle perspective is, of course, the fact that we had a major cycle trough forming in March of last year. So that's given us a big bullish impetus, if you like, to the market. And when longer cycles exert their pressure, they often tend to squeeze the shorter cycles out. And so the shorter cycles, when they are moving in the same direction as the longer cycles, provide the extra impetus for the bullish move. But there is no evidence really of those shorter cycles pulling the market down. You know, we're not seeing nice clean M shapes with lots of downward movement in those shorter cycles. And because that movement is simply not present, it's been squeezed out by the longer cycles, it is not really available for the composite model line to tell us where the market's going to start coming down. We should be very careful of accepting the composite model line in its prediction that the market is just going to keep moving upwards. That would be a misinterpretation of what the composite model line is saying. I think that's an important detail to bear in mind. Let's zoom in on the same period of time as we were looking at in the other analysis, and you can immediately see the difference as demonstrated by the composite model line. We are, of course, still expecting the bounce out of the 80-day cycle trough as we were in the other analysis. So there's no difference there. We're experiencing a bounce out of the 80-day cycle trough. What is the difference? Well, here in this 80-day cycle, which is in fact the same 80-day cycle as we were looking at in the other analysis, there is the nest of lows. We're expecting a trough, according to this analysis, at roughly the same time, the end of November, early December perhaps, which will be the trough of the next 80-day cycle. According to this analysis, it's a trough of the 20-week cycle. According to the other analysis, it's a trough of the 18-month cycle. So what is the difference? Well, two things. First of all, the peak, according to this analysis, is expected late. That's a very important detail. So the move up from the 80-day cycle is expected to bring us, first of all, to a much higher peak, of course, but also a later peak. And the second big difference is that the move down into the trough towards the end of November is expected to be much shorter in duration and also much less impressive in terms of the price movement. So those are the two really important differences between these analyses. I'm still watching both of them, and if we experience an early peak in this 80-day cycle, then I am going to start preferring the other analysis, indicating that the 18-month cycle trough lies ahead of us. However, if we don't see an early peak in this 80-day cycle, then I will continue to favor this analysis. So that is the difference between these analyses. Now let's take a look at what's been happening recently in the market. And that bears quite a lot of discussion, so we're going to spend the rest of the video today speaking about this in detail, because some really interesting things happened in terms of the price action. So the first question is, has this 80-day cycle trough formed? Because as you can see, price bounced upwards very nicely, but then it moved strongly downwards for 2 days. I'm recording this a few hours, a good 4 or 5 hours before the US markets open on Wednesday. And so this is actually outside of regular trading hours price action that you see reflected on the chart over there. So we can't take that too seriously. But there was certainly a strong move down yesterday. And of course on Monday there was a bit of a move down. So some people might be asking themselves, is this really the 80-day cycle trough? Sentient Trader has positioned that as the 80-day cycle trough. In other words, they have marked those hollow diamonds. As I've mentioned, they're hollow, so it's not absolutely convinced. So how do we actually confirm that a cycle trough has formed? Well, that is where our cycle tools come in useful. And now I mostly speak about the FLD in these market update videos because the FLD is, in my opinion, a much more reliable, it's a more robust tool. But there is another tool, of course, that Hurst defined, which is the VTL, the valid trend line. And the valid trend line is also useful, but the valid trend line does have some limitations that I should point out. Basically, without going into too much detail and boring you all, the VTL is much more closely based upon the analysis you see on your chart, because the VTL connects two consecutive peaks or troughs of a particular cycle. And because it is more closely based on the analysis you see on your chart, the VTL has the difficulty that it tends to be a bit of a self-fulfilling prophecy. Because it is based on the analysis you see on your chart, it tends to confirm that analysis. So you need to be careful of the VTL for that reason. But the VTL is very useful for confirming that a trough has formed in the markets. So as you can see, on Thursday and Friday of last week, price crossed up above the 10-day VTL. Now, when price crosses above a 10-day VTL, that confirms that a trough of the next longer cycle in the nominal model has formed. It sounds more complicated than it is. Here is the 10-day cycle displayed as a diamond at the foot of the chart, color-coded, of course, in Sentient Trader, so that we can recognize it. That's the 10-day cycle. The next longer cycle in the nominal model is the next one up. That is our 20-day cycle. And so when price crossed above the 10-day VTL, we confirmed that a trough of the 20-day cycle has formed in the markets. And so, of course, that there would have to be that trough of the 20-day cycle. So how does that help us identify that the 80-day cycle has formed? Well, what we then do is we then measure back from the confirmed trough. We measure back to the most recent fairly prominent trough, which is over here, 32 days ago. So is it possible that what we have seen is simply another 20-day cycle trough forming? And let me activate my pen again. Is it possible, in other words, that this 20-day cycle trough could have formed over here, and that is then the trough that's being confirmed? And the answer to that question, to keep it simple, is no. After 32 days, that cannot really be a 20-day cycle trough. It must be at least a 40-day cycle trough. And so by confirming the 20-day cycle trough having formed on the basis of the VTL, we can then also say that that was a 40-day cycle trough. We can extend the same logic, and I'm not going to repeat the process again here, but we can say with some degree of confidence that this trough is the 80-day cycle trough that has formed in the markets. And that is why Sentient Trader has helpfully positioned those diamonds there to provide us with some confirmation that the 80-day cycle trough, I should say, has formed in the markets. But now, if you were actually trading this situation, it's been an unusual first 10 days, if you like, of that 80-day cycle. So what is happening? Is it possible that the 80-day cycle still lies ahead of us? It is still possible, because you must remember that even though we have confirmation on the basis of a cycle tool having been crossed, a Hurst cycles approach is as much an art as it is a science, and achieving 100% certainty is one of those holy grail things that I believe is not really possible. It's never possible to achieve 100% certainty. What we need to learn to do is to apply our degree of uncertainty, if you like, and nevertheless be able to identify profitable trading opportunities and be able to work even though we continue to have some uncertainty. So it is still possible that price is going to come down and form a lower trough, and that will turn out to be the 80-day cycle trough. It is possible. In my opinion, it is unlikely. I do think that the 80-day cycle trough is formed. Of course, I could prove to be wrong. The important thing is, even if I'm proved to be wrong, I don't mind. I don't have much of an ego about it. If I'm wrong, that's too bad. The important thing is not to have been trapped into any kind of losing trades at this point. So how would we potentially have identified trading opportunities, and what would have alerted us to the fact that there was going to be some uncertainty around what was happening now? Well, let's put up the FLD, and I'm going to show the 20-day FLD, which, as you know, is my favorite FLD in terms of these market update videos, because it provides us with useful identification of trading opportunities over the next sort of 10 days to 2 weeks, that sort of time period, which is perfect for these market update videos, and it proves to be a very reliable FLD. So you know, of course, that we have our sequence of interactions that we identify, and the first thing that is expected when price bounces out of a potential 80-day cycle trough is that it will come up and cross above the 20-day FLD. I should point out that whenever price bounces out of a potential 80-day cycle trough, we are always presented with a potential dilemma. Not always, but almost always. You will know that in the identification of the sequence, we have an F category interaction where price crosses down below it, then a G category interaction where price finds resistance at the level of the FLD, then an H category interaction where price comes down into the 80-day cycle trough. Now, there is a recognized anomaly that occurs sometimes, which is that we get a double GH category interaction whenever price comes up to the 20-day FLD following a potential 80-day cycle trough. We have to consider the possibility that this is potentially a double GH category interaction, which means the price is then going to come down and form a lower 80-day cycle trough. Now, in my opinion, as I've mentioned, I don't think that's happening, but let's focus on how we could have explored the possibility of that and how we could have approached this last week. So I would like to start introducing some fairly interesting ideas in terms of the details of the way in which price interacts with an FLD. I speak about price interacting with an FLD in all of these videos, as you know, and I tend to be fairly glib about, price crossing and price coming down and finding support and bouncing off and crossing and so forth. But in fact, there are some details that you really need to focus on. And those who've studied the FLD trading strategy in detail know that it's not as simple as I sometimes make it sound. So let's consider this interaction with the 20-day FLD that occurred on Thursday of last week. And I think you can see that on Thursday of last week, price came right up to that 20-day FLD, touched it, and then actually moved down again. So what happened? So to start this consideration, let's consider the moment at which price touched that FLD and consider some of the details of that. Now we have a system, I hope that you're following us on Twitter, we have a system that automatically tweets when some market events happen. It doesn't tweet every single FLD interaction, only the ones that we think are likely to be interesting as the markets unfold. And so last week on Thursday, there was a tweet issued by our system about price touching the 20-day FLD. Let's take a look at it. So here is that tweet, which was issued at the moment that the price touched that FLD. As you can see, it happened at 7:39 p.m. Now that time is in Central European time, where my computer is based. I think that's the time that I'm seeing on the tweet. And in fact, the server that generates these tweet alerts is also based in Central European time. And so that was the time at which it happened. It was, I believe that's about 20 to 2 in New York time. So it's kind of after lunch, unless of course they're taking a long lunch in New York. Who knows what happens in New York? So you can see the important details here. We were expecting an 80-day cycle trough. There's our very neat nest of lows. There's the 18-month cycle trough in the middle of July. Interestingly, no pins. So this analysis actually has not been influenced at that level, but it is nevertheless producing the same analysis as my preferred analysis. And there is that tweet. So what are the details I'd like to speak about? First detail that's important to consider is what time does price interact with the FLD? Because, of course, each one of these bars represents a day's worth of trading. If price crosses strongly through an FLD early in the day, then that has a different meaning to when it crosses towards the end of lunchtime, in the day, or towards the end of the day. And so this is happening slightly later in the day. The other really important thing to consider, in my opinion, is the average true range. Now, it's not something I ever really speak about in these market update videos, but it's a very important consideration. If price touches the FLD when the bar has already reached further than an average true range. Now, if you don't know what an average true range is, then please look it up. I won't explain it in this video. It simply represents the average range of each bar of price action. And so when a bar has already pretty much achieved the average true range and then touches the FLD, generally that's a sign that the market has already put in its average effort and now it's reaching the FLD. And FLD is a very important level, even though we are expecting price to cross above the FLD at this point. And our expectation was clearly that we're expecting price to cross through it because we're expecting an A category interaction here. Okay, as price bounces out of the 80-day cycle trough, even though our expectation is for price to cross through it, if it does so after having already achieved one average true range, we need to take that interaction with a pinch of salt. That is why this Twitter system doesn't say, here is your A category interaction and is price crossing above it, because an interaction is more subtle than that. There are details that need to be considered. And so in this particular case, price had already moved up by at least one average true range. We haven't displayed the average true range on this chart, but it's clearly already at one average true range if you look at the recent range of those bars. And so having already done that, at this point, I would sit up and take notice and say, oh, it's interacting. I would not jump into a long trade. And that's the kind of subtle detail that I think it's really important to bear in mind. So that's the first thing to say. Let's zoom in here even further and take a look at some more detail. Here you can see how price came up at the end of Thursday, or at least after lunchtime on Thursday, touched the FLD. It did not cross strongly above it. It represents an extraordinarily accurate example of price potentially finding resistance at the level of that FLD. As I've mentioned, whenever price bounces out of an 80-day cycle trough, we have to bear in mind the possibility that we are seeing a double GH category interaction. And that was a distinct possibility. Although the fact that it crossed the 10-day VTL tended to point out that the 80-day cycle trough probably had formed. Then an interesting thing happened because price slipped across the FLD over the weekend. Now, if you find that surprising, you should bear in mind that, of course, Hurst's principles state that, or at least it's not actually stated in one of his principles, I don't think, but it's one of his overall guidelines, is the fact that these cycles influence price movements over weekends and over holidays. So whether we're trading or not, we need to consider the cycles as continuing to move, which is why sentient traded charts display gaps over the weekends, because that is the correct way of doing it. And you will notice if I change this chart to a median line, that the median line slipped over that FLD, or I should say crossed above it. I'm being a bit rude describing that as slipping over the FLD. It's just not a very good price cross, as I think you can see. And it did that on Sunday. So on Sunday, it crossed above it. You must remember that price cross is only considered as valid when the median price crosses above the FLD. So although the median price did cross above the FLD on Sunday, and on Monday we had a median price that was ever so slightly above the FLD, yesterday's price action and today's price action so far has brought price right back down to the FLD, indicating that this is a very poor cross. There is no, I call it a cross, it's a very poor example of price crossing the FLD. So this is not the kind of example of definitely jump in and enter into your long trade. And so the jury is still out, really, in terms of this price crossing of the FLD, and it is not an absolutely clear example of an A category price crossing the FLD. So what is happening now? Well, one of two things could be happening. Price could be coming down into the 80-day cycle trough, but in my opinion, as I've already mentioned a few times in this video, the 80-day cycle trough has formed. So what is happening now? Well, what would be happening now is that price is coming down and is forming, or has formed, the 10-day cycle trough. Can you see the 10-day cycle here at the foot of the charts? There's our very neat nest of lows. When we're talking about the 10-day cycle, we should really start looking at some intraday price charts. Go down to the 4-hour price chart or the 1-hour price chart perhaps, and look at more of the detail, and we can see that more clearly. But you can see how price has interacted with the 10-day FLD. So let me turn off the 20-day FLD, and there is the 10-day FLD. You can see that price crossed up above the 10-day FLD over here, generating a target to the upside, which interestingly has not been reached yet. So that's a little bit of a worrying sign. There's distinct bearishness coming in there. Price has then come down to the 10-day FLD. What are we expecting to happen at the level of the 10-day FLD at the time that the 10-day cycle forms a trough? We are expecting price to find some support at the level of the 10-day FLD. Price has slipped below the 10-day FLD quite substantially. So that is another anomaly, indicating that there is more bearishness than we would expect at this time in the market. If price succeeds in really bouncing up strongly, which is a big if, then we would, looking back with the benefit of hindsight, say, well, price did find support. But we are going to be on tenterhooks for today's price action to see what actually happens. If we take a look at, we can look at one shorter FLD here. We can take a look at the 5-day FLD. Although I should point out that the 5-day FLD on an end-of-day chart is probably not very helpful because of the level of detail, which is really inadequate for making any trading decisions on the basis of it. But you can see price crossed above the 5-day FLD and did indeed reach its target. I think it reached its target over there, or perhaps it reached its target on Monday, and it has now crossed down, moving into the 10-day FLD, at which point, of course, it would generate a target to the downside. It has reached that target. I should actually clear all these pen marks. It has reached that target. It reached it yesterday over there. That is the target for price crossing down below the 5-day FLD. Again, price overshot that substantially to the downside. And so we are seeing some increased bearishness coming into this market. And so we will be watching with great interest to see what happens in this market. I hope that looking at the details of this FLD interaction have provided you with some useful information in terms of how to work with these FLDs and the way in which price interacts with the FLD. We very rarely recommend jumping into a trade at the moment the price touches an FLD. Whenever price touches an FLD, it's a bit like a sit up and take notice and then make carefully considered trading decisions as a result of the way in which price interacts with that FLD, which in this particular case would not have suggested jumping into a long trade immediately on the basis that that 80-day cycle trough has formed. So we will be watching with great interest to see how price action unfolds, to see whether this 80-day cycle trough is going to hold or whether we're going to experience a slightly later and deeper 80-day cycle trough. Of course, there is a very bearish possibility that might just be presenting itself, which is that this peak here is all the energy that's left in this market and the price is going to start moving down into that 18-month cycle trough. But that is not very likely in my opinion. It's something that it would certainly be quite interesting to consider. There's a final thing that I'd like to point out in this video. I know it's been a very long video already, but a very interesting little detail which I meant to point out last week, which is really worth pointing out here. If you measure the number of days from the trough in March of last year, and if I can position my mouse there we go. If you measure the number of days until the Monday trough of last week, you can see 546 days elapsed. So here's a test of your Hurst cycles knowledge. What's the average wavelength of the 18-month cycle? Discovered by Hurst, I should point out, 50 years ago. If you take a look at his Hurst cycles course, you'll see that the average length of the 18-month cycle was found to be 546 days. So last Monday was the perfect anniversary, if you like, of the 18-month cycle. So that raises some interesting questions. Is it possible that the 18-month cycle trough formed last Monday? Well, of course it is possible, but I haven't shown that possibility in any of these market updates because it is a very poor analysis in my opinion, not because of the wavelength of that 18-month cycle, which would be perfect, but because of the way in which the shorter cycles break down and that complex puzzle that I mentioned earlier in terms of performing an analysis, the way in which that works. It just does not produce a good example of an analysis. But it raises a really interesting point in terms of the way in which these cycles manifest, particularly when you're performing a form of spectral analysis. Sentient Trader performs a pattern recognition approach, which is the approach that certainly for me proved to be groundbreaking and life-changing in terms of analyzing the markets. A lot of other cycle analysis approaches use a purely spectral analysis approach. One of the interesting things of performing a spectral analysis approach is that the fact that a trough of some magnitude, and at the moment we're thinking it was probably 80 days, but a trough of some magnitude formed at exactly 546 days would contribute towards a spectral analysis in terms of identifying a wavelength of 546 days potentially. And so spectral analysis does not include the harmonic ratios between the cycle wavelengths. And of course, that was the subtlety that Hurst added to the spectral analysis that Sentient Trader performs at the start of its analysis process. But the interesting thing is that it's very useful to keep an eye on these average wavelengths, because you will often see cycle troughs forming. They might not be of the magnitude that the cycle wavelength would lead you to expect, but you will often see cycle troughs forming at the exact days for the perfect wavelengths of the various cycles in our nominal model. So it's always something to keep an eye on. I do hope that you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.